Welcome back to Indianomics. I'm in conversation with Aurodeep Nandi of Nomura, Kaushik Das of Deutsche Bank, and Anubhuti Sahay of Standard Chartered Bank. All of them top-notch economists, and we are preparing ourselves for the GDP numbers, the fourth quarter and the full-year GDP numbers for FY24-25 that are going to be announced on May 30th. Anubhuti and gentlemen, thank you very much for your time. Anubhuti, I just wanted your word also, because your growth numbers for the fourth quarter are weaker than consensus. You are standing at 6.5, as you just defended. Do you expect that there is a chance that if there is a negative surprise, the Reserve Bank can push to 5-quarter?
I think, Latha, probably we will have to wait a little bit more before we start penciling in a 5-quarter kind of repo rate just as of now. At this point in time, I think terminal rate of 5.5% looks pretty good. There is definitely a lot more room when you are simply focused on inflation. There is a lot more room to cut if you are focused on the global uncertainties. But if we have to go towards 5-quarter or 5%, I think the trigger has to come from GDP growth numbers over the next few quarters. And there are viewers that while the current momentum has not been good, there can be few offsetting factors which can make FY26 look not as bad as what we are anticipating at this point in time. True, there is global uncertainty, but at the same time, as you mentioned earlier, policy has turned counter-cyclical. 100 basis points of rate cut immediately gives a saving of 0.3% of GDP to whoever has borrowed. And I'm only talking about the retail borrowers. I'm not talking at an economy level. The tax cut, which probably has faded away from our memory, that's another 0.3% of saving in the hands of consumer. It might not translate on a one-on-one basis in terms of increased consumption, but it definitely protects and defines a floor when it comes to GDP growth numbers. So our sense is, unless GDP growth for FY26 starts showing signs of slipping below 6%, till that point in time, 5.5% looks like a decent repo rate to bottom out at, especially given the very aggressive stance which RBI has taken on liquidity infusion.
Okay. Now, I polled a dozen economists, all top-notch. So my sense is no one gave me that bearish a number. The only 5.8 we got from Nomura was for the full year, but otherwise we haven't got a sub-6 number. So perhaps the Reserve Bank's hand need not be pulled. But Kaushik, what is your sense about any further informal sector data and therefore that coloring the GDP numbers? Because now the MOSPI is much better equipped. You've got monthly PLFS numbers and you have got this unincorporated as-used number. So do you think that can anyway impact positively or negatively the GDP number?
So, Latha, first of all, we are not very negative on GDP growth relative to our peers.
Yes.
So we have 6.5% growth. And, one thing which I should...
1 minute. You have 6.5 for the current year?
For FY26, yes.
Okay, you stand with the Reserve Bank there. Okay.
And remember, RBI reduced the growth forecast from 6.7 at a time when there was peak negativity about global tariff. And since then, a lot has changed. And, there's been a reversal. IMF also cut the global growth from 3.3 to 2.8 when there was peak negativity. Now, a lot of people are considering whether growth can be higher in China from the peak negativity that we have seen, or in US. All these discussions are taking place. So it is possible that maybe RBI wouldn't have cut from 6.7 to 6.5 if the reversal had already happened. So we are comfortable at 6.5. To your question, informal sector data obviously makes the data set more robust. Normally, the data have been revised higher after incorporating all the broader set of data from the provisional data. So I would think that going forward, there could be a bias of revising up the forecast of the previous quarters as well. Also, one thing you should remember that April to September, the government will be spending their 11 trillion capex in the normal trend like each year, compared to last year, April, September, where they could not do much because of elections and then heavy monsoon. There'll be a big year-on-year bump on government spending related growth in April, September. Plus, what Anubhuti said, I think it's very good news for the consumers that inflation has come off. Tax rates have been cut, so real disposable income has increased. Monsoon is supposed to be above normal, so that's good for rural, growth. And RBI has flushed the system with liquidity for allowing transmission to happen. Also, the bigger medium-term story is that India is cutting tariff rates in a big way, not just with UK, they'll cut with US, with Europe, New Zealand. So that's very good news for the consumers because inflation comes down in India over the medium term because of the tariff rate cuts. And that's like extra, additional savings with them, which they can spend going forward. So I would not be very negative on India's growth at this stage, given the reversals that have happened with the tariff. India probably will manage 6.5% growth this year and next year as well. But the only thing is that India's potential growth rate is probably 7% or higher. So relative to that, we are still on the lower side. And that's why we think RBI can probably come down to 550, 100 basis points rate cut becomes meaningful to allow transmission to happen, but nothing more than that, because the deeper you cut, and then if you see inflation or growth going up after a few quarters, market will pressurize RBI to reverse those rate cuts if you go very deep in the rate cut cycle, which then creates a problem for RBI, because once you finish the rate cut cycle, you would want to wait for 1 year or 15 months before you start the rate hike cycle. So I think 550 is an appropriate terminal rate, but after June, I anticipate a pause in August, because you'll already get a 50 basis points rate cut through liquidity and repo, and then probably in October, the last rate cut.
Yeah, well, I have to rush to wind this down. Aurodeep, all points taken about, the liquidity flush and the tax cuts and what Anubhuti and Kaushik are pointing out. But, there is uncertainty. Investment comes only when there's certainty. And that certainty has been very rudely shaken. Even after the reciprocal tariffs have now become more rational at 30%, I don't know how much investment will happen. And even the government's capex faltered. When you started looking at December, January, they were not, January, for instance, was not as good, although there was no election to pin it on. So therefore, do you think that, investment, just give us an idea of what you're expecting in terms of consumption growth and GFCF, that is gross fixed capital formation, anything that you want to train our eyes for the May 30th numbers?
So on the, if it's about FY26, then we expect consumption growth to weaken. Yes, there are positives, but we also need to consider that even things like rural consumption. Yes, it's picking up, but if you look at the rural indicators, you've got two-wheelers doing badly and some other tractors doing better. So it's not even the rural recovery is uneven, and our own analysis on rural terms of trade has been that it's going up, but it's going up and down also in that trend. You're absolutely right on the investment side of things. Even with tariffs possibly lower, there's still a lot of uncertainty. There's a lot of uncertainty on what kind of tariffs India will negotiate with the US, what the US will negotiate with China. If that is dramatically low, then will the China plus one model still hold? So I think there are a lot of ifs and buts. And in such a scenario, in the absence of strong domestic demand, it is natural that private capex sort of takes a backseat. A lot of focus will again remain on government investment trying to drive the engine. So maybe for investment, we are expecting it to sort of pick up this year compared to last year, which was really bad, as Kaushik mentioned. But I think overall, because consumption is on the weaker side, because global growth could be weaker, because of higher uncertainty, we are on the bearish side on growth.
Fair point. Actually, there are enough factors to be bearish, to be fair, that even urban consumption was stagnating. There were several indicators. And, uncertainty always means that the businessman will not open his purse. But there are positives in terms of defense, actually, as a propeller. In the past, we've always seen post-war-like scenario, there is a kind of an investment cycle pickup. So we could see some positives from that very unfortunate event as well. Let's see what May 30th throws up for us in terms of trends in Q4 and all of FY25. Thank you very much, Kaushik, Aurodeep and Anubhuti for participating in this conversation. That's it on this edition of Indianomics. Thanks for watching.